Okay. Hey, everybody. Welcome to the new podcast from Digital Data Café. I'm CEO and founder from Driven IQ, Albert Thompson. Today, we have the one and only CFO and finance extraordinaire, Dave Antokal. Just before we get started, though, I got to tell you, Dave, is finance guru, knows how to navigate startups, knows how to navigate, businesses and funding and rounds. He's personally himself, if I'm not mistaken, has been a part of over 100 small companies through their raises. And I believe 12 of those were unicorns. Is that right?
That's right, Albert.
So tell me a little bit more about your story. How did you get to where you're at, and what's your background?
Yeah, of course. So I started just under 20 years ago in my career, 2003. And I didn't really, like most people in business, like, how do you start a business? What do you want to do? Like, what's the best experience for business? And, I had heard different things, marketing, finance, accounting. And the thing that I just kept coming back to was like, if you understand the numbers, you can understand like how businesses make money. And if you actually want to start your own business one day, or get into business, like that's a great way to do it. So I started out, my first job was at a global accounting firm, like a really big one, like 100,000 plus employees.
Wow.
And I wasn't that good at it. I was entrepreneurial and, I liked more working with small, exciting businesses. And I had, for the most part, I worked with half my time was with one client, Goldman Sachs. It's a very large investment bank in New York. So it was a bit one-dimensional, and it sounds glamorous maybe to some people, but
sure.
When you're on a big client, the problem is you're one of 60 people on that client.
Right.
If you're on, a small client, you might only have 2 or 3 people, and that's really where you learn the business. Wow. So my idea of going into accounting to learn business wasn't necessarily wrong, but I just didn't, do it right. So after that, I kind of had a dream to always start a business. So at,
really?
24, 25,
I
started a business. So it was, you might remember back in the day, there was these yogurt places like Red Mango and Pinkberry.
Yes.
Like plain flavored yogurt. So there was it was a big deal in Europe and South Korea. And I had a friend from South Korea. I had known someone that had gone to Italy and said this stuff is taking off there. So I got in the rights to do it in New York. So I started the business and it bombed. I did it for about 2 years, and it was, everyone asked why I didn't have vanilla, why I didn't have chocolate. It was this plain flavored yogurt. Retail employees can be very difficult to manage. People were quitting, but I had a backstop, and that was I was a CPA, and my stepfather had a CPA firm. So for the next several years until I found my next business, like most entrepreneurs, you gotta kill time, look around. Right. I decided to go work with him doing small business tax. And it was a great experience. I got really, really good at navigating the messes that are small businesses. And I dealt with tax problems. I dealt with accounting problems. I helped companies sell their business. I helped people when they were getting divorced, kind of go through that whole process. And I met a client that was doing real estate and event spaces. And what that is you have a very large venue, and you might rent it out for $10, $20, $30, $50,000 a day. Yep. So we decided, she had the business experience, she had the event experience, I had some business experience. I had run a payroll, I was really good at accounting, I understood tax, and I was going to be the business guy. So I was going to be the guy that filled out the insurance forms, talked to investors, negotiated with landlords, did build outs. So we partnered up. And that's what I did. I was essentially the CFO at a very young age of a small business. And we grew it. And we had about half dozen locations. We raised some money. We hosted all of Fashion Week. It was a really, really nice, sizable business. Wow. And in 2014, business sold. I had nothing to do. So my business partner.
Just to ask you this. So if I'm hearing you correctly, right? So you had the yogurt business, you flopped, but listen, we'll go back to that. But I think all business entrepreneurs have to somehow face plant once or twice in their life. I think you'd agree to be able to learn the pitfalls. And then you get the finance side of the background, but then you go right into this event space. And, you're doing Fashion Week. I mean, how did all this come together? I mean, this is great.
It's a great question. So, and I don't really talk about this because it was so long ago.
Right.
I started that in 07. So what happened was it kind of just like went terribly, right? Because we started in 07. Think about that. That was right before the Great Recession, right?
That's right.
So we started in 07 and we raised about, I think it wasn't much. It was like under $1 million to build out our first location.
Wow.
The build out went like triple over budget. So we got crushed, absolutely crushed. And we almost went out of business. Like my partner had put in a ton of our own money. Like it wasn't fun. It was, like most entrepreneurs, you have those sleepless nights and you're like, wait, I'm actually paying to go to work. You know, like,
yes.
And you take in friends and family's money and you feel terrible about it.
Yes.
It's not fun. Like it's everything you've heard about, like being really stressful entrepreneur.
Yep.
So we actually got bailed out. We had a huge event from BMW booked, like huge money where like they wanted it for a week. They wanted to be our introductory thing. And it was so much money, it just covered the whole build out. And from there was off to the races. Like we definitely did it differently after that though. What we did differently was we wouldn't do the build out ourselves anymore. We partnered with landlords. So it would be, let's say a very large venue, 100,000 square feet in Manhattan or 50,000 square feet in Manhattan. In Manhattan, that's not like,
that's
a suburb. Like that's like,
massive
a property could be worth hundreds of millions of dollars, right? So we partner with them and they say, you know what, we're going to redevelop this in 3 years, but we have nothing to do with it for 3 years. So we worked out like a profit split and said, well, we can get you some publicity, some cool events, like, some of our big clients were like Nike, like Range Rover, like very sexy events. Yeah. And you can get like the publicity and we'll kind of just sit back and like manage it. And that was it. And that was our business. The problem with that business was the event spaces came and went. So, it could be you lost 25% of your revenue when they're like, okay, it's time to tear down this big building in Soho and build a skyscraper. So nothing you can do about it. So it was a frustrating part of the business, but it was a fun business. And it was, it was cool to see how something scales and you're kind of like, oh, now instead of going, at the beginning, it was like, I'm paying to work. Now it was like, oh, I'm making more than I deserve, like at a certain point, because that's a business. It scales very fast.
It does. And I definitely want to finish the rest of your story, but just going back to what you were talking about here, this is really interesting, right? Because a lot of businesses tend to face that same dilemma that you're talking about, right? The first year, super tough. Second year, super tough. When are we going to break even? I'm not taking a paycheck. I'm not taking an earning, but we got to face that moment in time where it's like, how do we fund this? So, you typically what, you have your friends and family around, or you go out and you get, like you said, you get some initial money to get things started. What would you say the small business person out there that's just listening to this, what would you say, like, good advice for them to just kind of get started and how should they try to formulate their business? And now look, we know all businesses are different, but any type of advice you could give somebody out there, because you just said you went to raise $1 million. I'm sure there's people out there saying, well, how did he do that?
Yeah. So the best advice is like, be naive, because if you actually knew, and Albert, I'm sure you're aware of this, like if you actually knew the pain that you would go through, he wouldn't do it. Like the media has a way of making every successful entrepreneur look like it was so easy. Yes. They never show you the 90% of businesses that go out where the people, like get have to off. Face, bankruptcy and stuff like that. So some things for like small business, I'd say is as much as you can try and do things above board. And try to mitigate your risks. Like, don't guarantee a ton of debt if you can. Don't try and get out of guaranteeing leases. You can pay a bigger security deposit. And if you can't do a business and you need a business that's very capital intensive, start out doing something else. And most businesses, very few businesses that I've ever seen are exactly what they plan to be.
That's a really good point. That's a really good point. Please elaborate on that, because it's always changing, right? Your model can change, especially when you're going from a startup to a scale up, right? You have room
It's
to afford to move the model, right?
Yeah, definitely. It's really, the reason is, one, if it's that good a business, someone's going to copy you and they're going to come in and try and take your turf, right? When we were doing the event space business, we weren't the only game in town doing it. Other people were doing event spaces.
Right.
We had to differentiate ourselves. So we had, you basically have to, when you're starting a business, kind of keep an open mind and know, and say, okay, we don't know what's going to happen, but, we're going to go with it and we're going to stick with it. One mistake I had made at the beginning was not being all in. So I think that's like another important thing. Like when I started the yogurt shop, I didn't, it's going to contradict what I just said with mitigate risk, but I was a little hesitant. So I was part-time working with my stepdad for part of it and part-time running my yogurt shop with the idea that I was going to have 300 yogurt shops. And I quickly, it was good because I recognized within, 3 to 6 months, I wasn't the guy that was going to run 300 yogurt shops. Correct. The economics of a yogurt shop, best case scenario is if you want to manage it, you make 100 grand. If you want to hire a manager, take yourself out of it, you make 40 grand. If you got a partner, then you're down to 20 grand. Oh, and you want to raise capital because you want to put all your money in? Now you're down to 10 grand per yogurt shop. There's a lot easier ways to make money.
That's right.
That's right. 300 yogurt shops, it's a great way to do it, but that's a lot of stress and a lot of debt.
So which actually, I was gonna say, which actually goes back to what you just said, right? Which is that if you could go back to it, any capital intensive business, you would say, do something different. So this is kind of just what you were talking about. So do something. So what other ways can they do something different? What other things can they do to shift?
So back then it was like, you didn't really have like all the, obviously the internet existed. We all remember what the internet was, but it wasn't as easy to start a business. So I would say, like, if you look at getting experience in a business is always good. So if you want to open up a restaurant, go work at a restaurant, don't just, and that, like, there's a lot of people that are like, well, I don't want to work in that industry. I want to own it. And, I'm not going to fast forward too much, but when I left my last business, one of the businesses I looked at was an event equipment rental company. So, and it was one of those things where I worked in it for 3 months before I bought it. And then I said, I'm not buying this. I'd have to, wake up at 6 a.m. or 5 a.m., commute an hour. It's a 7-day-a-week business. It's very, very stressful. And again, it kind of there's a lot of great, smart people in the event equipment rental industry, but it's not always like that. And it kind of reminded me more about my yogurt shop than it did my event management company, which, was, you ask someone to do something, they do it because, that's their livelihood. Where I think when people at some of the lower level jobs, they are more likely to not care about their job or think it's, expendable, they can move. So they don't, they might not show up, and it's hard to run a business like that unless you have extreme scale.
Absolutely. So take us through the rest of your story. So you went from the event rental business, you sold that,
I never actually did the event rental business, but
the
event space business.
Space business. My apologies.
So then I looked at so many businesses, Albert. Like, I looked at 10 businesses, 15 businesses. I thought I was going to do investing in businesses. I had invested and started helping run a safety harness company at one point on the side. Again, wasn't all the way in, and I had a partner for that. But I never really found anything I was passionate about. So that's another thing about when you're starting a small business or any business, you got to be passionate about it. You got to love it, because if there's enough people out there that are really into business, and it's really, really competitive, and people are willing to work, 24 hours a day. And there's always someone like hungrier than you. So you just got to be really into it. And I couldn't find anything that I was like waking up in the middle of the night thinking about and being like, oh, that's so cool. So, so then I started, consulting, and people just would ask me, hey, can you help me out with this? Or, they knew I had a lot of business experience, and I, was relatively young at the time. And they're just like, oh, help me out with this. Can you help me out with that? And then, that was 2014, and startups were getting, pretty popular. I had, I was in college when the .com boom, kind of collapsed. So I kind of was like a little like, is this thing real?
Right.
But it was different, this time around. So people started asking me, and then then more people started asking me. And then I was like, oh, I've been, it's kind of like you come to after a couple of years, I came to this realization, oh, you know what? I can make a nice living out of this. And that sounds like a lot of fun. So now my business is working as, kind of just guiding businesses. Most of them are tech startups, but there are some more traditional businesses, in, like public relations or like wholesale companies or, direct to consumer companies, but the majority of them are tech companies. And I'm able to kind of give this wisdom to companies. And my bread and butter has been, helping these companies scale. So it's I usually come in around. So let me start by talking about some of the rounds of investment. Usually you start off with like a friends and family round, or you put it in. This is purely for venture investment, which is like such a small portion of the world businesses that are started. The local pizza place was not started with it as a venture investment, the companies that power, all small business, that's not typically what we're talking about here.
Sure.
But for the purpose of this conversation, I'll talk about that. And I will say, I can talk about those companies as well. But it's a totally different structure. So
I think that's good. I think that's what we should do, right? Because people listening could be two different sides. So let's just walk through. Let's walk through the series. Like the funding of a business, like you said, like a tech startup. If I'm just trying to do a startup, start with the friends and family round. What does that mean? And then how do I go from there? How do I maintain ownership? What kind of equity? What am I doing?
So when you start, so let's start there. So when you have like let's say you want to go the venture route, it's totally different circumstances, but usually there's, you need some money, right? You need to kind of build out a prototype or some kind of business plan, So you say, hey, you go to your friends and family, maybe some rich people, and you say, hey, I'm looking for a few $100,000. I just need to hire a couple engineers. And you might be, a lot of times the people are engineers themselves, which makes it a lot easier to build something out. So once you get that built out, you kind of say, okay, here's the market. Let me talk to some people, get some partnerships going. I think I might have something here. And at this point, you might go into an incubator. And what an incubator is, the most popular one is Y Combinator, where they basically, they'll take 7% of your business and
give you like 150 grand or something like that.
And run you through the thing. But the big thing is they introduce you to every single venture capitalist. That's right. And that makes your life really easy. So then you just fundraise higher, grow.
Right.
And that's like such a small portion of startups path. But a lot of times, you just get, so you have enough of a product, you have something there, maybe you have some customers. Some bigger companies that are doing a pilot, you get some logos, then you start going for the seed round. And the seed round is usually a couple $1 million. So that's like, and then you might, could be called angels, early stage venture capitalists. And you just kind of Google, find them, ask for LinkedIn introductions, go into their website, like cold emails, network, anything you can.
Well, now let me ask you this. This is great. So, if I'm out there and I'm trying to start my business, right? And let's say I've got this great idea and I want to create this t-shirt, pressing business. And I've got, a proof of concept here. We're going to do something totally different. I don't know. Who knows? They can do studs or whatever the case is, or who knows what they've got, or they want to create a bakery and somebody's out there listening to this and they're like, man, this is great. I want to go out there and I want to get my business started. So, a lot of times we hear about, hey, I just partnered with my best friend, Becky over here, and I gave Becky 50%. I took 50%. And now we're just, working at the side job and we're just, trying to make our bakery work, or we're trying to get our cookies to market. And so, a little bit different than that tech round, obviously. So I think that's part of a different, round than you're talking about. But let's say that they, do that and, they split 50-50. And then they decided they wanted to, try to get some angel investment. I mean, now what kind of percentage should they be trying to look at? I mean, try to help us navigate, because I think a lot of people are like, I don't even know how to, get to that first stage.
Yeah. So if they really are looking for something different, Usually the rule is that you give up about 20% in the early rounds.
Okay.
So,
so that's a good rule of thumb. 20% then is
yeah, I would say 20-25% is usually, so it depends, right? So it's like, because you basically have nothing, right?
Right.
So if you don't raise the money, you have nothing.
Right.
So if you're talking about like a traditional business, they don't really know. It's going to be hard to raise money, the venture capital route. So just so you know how venture capitals work, like let's say you have 10 investments, like let's say usually it's like a third of them are worthless, a third of them break even, and then let's say you're left with three. One of them might be 5x, one of them might be 7x, and the hope is one is 100x. Right. So like they don't really like they know they don't need a company that's going to be, just another t-shirt company that they can sell. They want the company, they want the Stripe, they want the Uber, the Airbnb, these really big companies that that you can make tons of money, because they know most businesses don't work out, as we talked about.
And the reason why I mentioned that, right, is because a lot of times you talk to these small business owners, and a lot of times they're thinking kind of in that mindset of, but they need to be thinking, if they want to go this venture route, they need to be thinking how can they be that anomaly, right? How can they be that differential company that somebody's going to want to put $1 million into? And it's one of those things where sometimes you got to step back as a business owner and think, can my business really scale? Right. And I think sometimes
that's the key.
That's the key. Can it scale? So, going back to
I would say, if you're looking for that kind of thing, like understand that not every business is going to be Uber, right?
Right.
And not every business is scalable. Like a car wash is a car wash, unless you have 10,000 car washes, right? So, so it's really hard to scale a car wash.
And that's okay for some business owners. Maybe they just want to own a couple car washes, and that's okay.
It's a great business.
I think it is. But I think for this conversation, right, if this is somebody who wants to look at your experience and like, hey, I want to get to that unicorn status, they need to be thinking scale. They need to think, different. They need to think, potential to venture route, right?
Yeah, definitely. And it almost has to sound dumb, right? Like I go back and I've worked with about 150 companies. And like I said, maybe it's let's call it 8-9% of them have turned into this, unicorn, which is $1 billion valuation or more. I would have 0% chance I would have been able to predict which ones. 0.
Is that right?
Yeah. Because it's just like they sound like dumb ideas.
You have to, really early. So tell us about that.
No offense to anyone, but like
no offense to anybody, but that's amazing.
Big. It's out because you could walk into this company, there's like 30, 40 people, and you're like, yeah, we're gonna be like 2,000 people or 1,000 people. We're gonna be worth $5 billion in 3 years. You're like, sure you are.
Right?
Yeah. Like your product, like there's 3 other people doing the same thing as you, because there's always 3 people doing the same thing as you.
That's right.
So it's real, like you just don't know.
It's funny that you said that, because I was just the other day I was listening to Reid Hoffman's podcast, and he was talking about how he funded Airbnb, right? And it was Air Bed and Breakfast or whatever. And when they pitched it, literally one of the other VCs, I think it was at Greylock Partners, literally said, "This idea is dumb. Who would ever rent out their personal space to strangers?" And literally said, "This is the dumbest idea ever." And guess what? There it is. So I agree with you. I think it's one of those things that just, you can't predict who's going to become the billionaire.
Yeah. And I think that's why, the venture capital exists, right? It's a portfolio method. You don't put all your eggs in one basket, and you got to do 100 of these things to actually get those, big venture capital returns. Because, you might, if you only do 5 of them, or 10 of them, you might not get that one that was 100x. You got to do a lot of them, but one of them will be. And that's mostly what the venture capitalists are looking for. So when you're putting together, your deck, obviously get some advisors. That's a big thing. Some people that have been there before. There's a lot of really rich retired tech people that, advise companies, and they love the energy of it, and they don't need to get paid. They might take some equity, but find people, there's a lot of people out there that want to help, and, just kind of, bully your way into their network, whether it's through LinkedIn or email, and, send thoughtful notes. And you should, if you get enough good advisors, they can make introductions and help you craft your story.
It's funny. One of the things that a few of the things that you've said, and these are the takeaways that I've gotten, right? So, first off, right, if you're going to grow your business and you're going to make it happen, you got to be all in. I think those are your words, all in. Then you said, you know what, you got to find something you're passionate about. you're not going to sell or grow your business if you're not passionate about it. And then I think this was one of the key things that you said, right? Is you gotta work the business. And I think you got to know your business in and out. A lot of people have this grand idea. I want to own car washes, but I don't even know how to do it. I don't even want to work one. Right. So, you really got to work the
That's a good
business.
point. Yeah.
Yeah. And I think, what you just talked here. So those are some really good tips. And then some of the things that you're mentioning here is tap into advisors, right? Find people who've done it before and get those resources. So if you could think of any other tips, based on your experience for a startup or somebody who's trying to get their business growing, what other tip would you say, hey, listen, this is one of the non-negotiables, right? You're working the business, you're all in, you're getting the consultants, you got the advisors, you're getting your pitch deck, you're doing all these great things. What's another non-negotiable that you've seen that's been a key successful ingredient for business?
I would say when you're picking a partner, most businesses should have a partner because it's too much stress doing it yourself.
That's
and you
right.
can't be there 24/7. You need someone to bounce ideas off of, but don't pick someone exactly like you. Pick someone with complementary skills. So if I'm the admin or operations finance person, if I were a partner in a business, it would be I need a sales and marketing guy. Right?
Right.
I can't be, I'm not, Albert, I always say you're very animated. You
Sure.
are very outgoing. I'm not as outgoing as you. So, for sales, I would not be as strong a salesperson as you. I would not have that energy to keep selling.
Right.
And so, when you get someone, and likewise, on the finance side, I can manage all that stuff, no problem. So it's,
Right.
if you get people that you kind of click together, one, you get different point of views.
That's right.
So when when you're pitching investors or you're pitching clients, you can kind of, you don't usually for big clients, you pitch, they might have their CFO and
right.
CEO, and usually the CEO is more of the visionary marketing person. So, you need someone that's not only a dreamer, but someone that's practical. So I would say, get a good partner.
Yeah, I
be
think
careful with that.
that's very, very careful with the partner. And I want to talk about that in a second, but I think you're exactly right about the co-founder and having somebody who can balance you out. Because you're exactly right. You've got to have that other side of it, to be able to cross check you and be able to pull you back. But you do got to be cautious, right? Because you've heard the horror stories about partners. Any words of advice for new startups on picking the proper co-founder?
It's really tough, right?
Yeah.
There's a lot of war stories out there. I've had some myself. So I would say as you mature, it depends, as you mature, I think you become very good at it. But if it's your first business, it really depends, right? Sometimes the co-founder is just someone that has all the money and you just need money.
You need money, right? Exactly.
Yeah. So it really depends, and you're kind of running the show, but they provide the capital. But it should be someone that mutual respect. Someone that has produced. Don't just go. A lot of times, it's kind of like picking a spouse. A lot of times people. You get a reference. People are like, oh, I've known this person. I work. A lot of times it's not usually you go speed dating and find a business partner. A lot of times it's like, oh, you gotta, I've worked with this guy for 10 years. He's looking to leave his corporate job. This is what he's good at. And he has all these connections, and, he sells the exact product that you're making to everyone. And he has those connections. So if he joins, you don't need to worry about sales, something along those lines. So I would say, just make sure that, and I would say work ethic, make sure they're willing to work hard, they're mentally stable. That's a really big thing. Not everyone in business is mentally stable, which is I'm sure we've all experienced.
It's terrible, especially when you're talking about things like where you had $1 million and you ran 3 times over. You don't know how you're going to keep the lights on. You don't know how to keep payroll going.
Yeah.
You got to have that mentally stable partner. I'm pretty sure it's
you don't want someone that's crouching in the corner, it's tough. So, and people that are willing, I would also say it's not always possible, but if you have enough of a financial cushion where you can take the risk, that's always really good on a partner. You don't want someone that, and that could just be a stage of life thing where, you don't want someone where it's like, look, I would love to keep this business going, and I know we've hit a rough patch, but I need to take a job. I got a mortgage, I got a family, and like,
That's right.
like I can't keep doing this. And then you're on your own, and it just gets complicated.
It gets very complicated. Speaking of, strengths and weaknesses and what you were talking about earlier, I was read a great book the other day, and it was talking about how, there's 97 things that you're really not good at. And there's
Mhm.
3 things that you're, fantastic at. Right. And, I call it, the magic dust, right? You got your magic dust. So there's the 3 things that Albert's probably really killer at, maybe it's the energy, maybe it's the sales, like to your point,
Mhm.
and you're going to triple down on those 3 things, but it's the things that you're not good at that you have to also, as a business owner, be able to identify to be able to
Mhm.
find those people. Right. So, full transparency, one of the things that Albert's not, this is not my strength is the finance side. So I think this is a good segue for me to ask you, how important is the finance piece in a business, and why is it, for some business owners, I'll tell you, listen, I'll be the first to say it. I've had several businesses where I was like, I can outsell myself through finance. I can out negotiate myself through
Mhm.
finance. I can just put revenue on the books and I don't need to button it all up. And it's always came back to haunt me. So why is it so important? Can you tell us?
Yeah. So again, there's different types of businesses, right?
Right.
So there's business like, it's cliche, but the phrase cash is king is, kind of one of those things.
Right.
So yeah, if you've raised $30 million and you're only spending, 200 grand a month and you have no sales, who cares? You
Right.
can go for a really long time. Doesn't really matter.
Right.
Finances do not matter, right?
Right.
Like,
Right.
like you need them for
Right.
taxes. A lot of small businesses, when I worked in tax with my stepfather, all they cared about was tax. They didn't, they didn't care
That's right.
about they how they ran their business. They looked at how much money was in the bank account.
That's
And if they
exactly right.
had, yeah, and they don't know how much money they're taking out, so if they always, and everyone kind of has that number in their head, whether it's like, I don't want my account to go under 100 grand. I don't want it to go under 10,000. Sometimes it's 5 million. It depends on your payroll, depends
Sure.
on your rent and your fixed costs. But I think you have to, so, at the beginning stages, I would say, like, you'd be surprised, most startups don't keep good finances.
No, they
And
don't.
they really don't know how much money they're making. They don't know how much money they're spending, but they know, like, every single founder I've ever dealt with knows how much money's in their bank account. Like, that's a
Right.
given. Everyone knows how much money.
That's right. That's right.
Because that's like, can we make payroll? Because no one ever wants to miss a payroll. That's like the one thing you never do. Because
Yes, that's the
people
debt.
take personal responsibility
That's right.
for that. And
That's
people, you have a trust with your employees.
That's right.
So I would say, like, finances get more important. And again, let's look at the 2 types of businesses, right? When you're looking at, like, let's take the car wash again. It's important because you need to budget. You might have, you might need to, but, car washes are very profitable.
Right.
So you might need to budget for your own personal taxes. You
Right.
might need to wonder how much money you can take out because you're buying a house. You don't want to take all the money out of the business. You want to know what the business is worth because you're looking to sell it.
Right.
And it's really hard to catch up. That's the other thing. You
Right.
can't just, like, run a car wash for 5 years, not keeping the books, and be like, okay, I want to sell it. So I'm going to be like, okay, well, I know how many cars went through, but how much money did you make? Oh,
Right.
what are your supplies? You can't be like, well, let me get back to you.
Yeah.
And
Let
have
me
someone
get my
you go
receipts and
back,
get
like,
yeah. Yeah.
do the books for 5 years. It's going to look ridiculous.
Right.
It's going to take forever. So, you never know what's going to happen in life. You might need a loan. You might, there's a million things that could happen. So you really want to keep, in these regular businesses, be pretty close. It never has to be perfect. Like,
Right.
no one expects your numbers to be perfect when you don't have a full-time finance team. So that's on that side of the business. When you're at a scalable business like the venture startups, you got to keep it clean. One, you have investors, right?
Right.
You took people's money. So they want to know, how's their money doing? How's your
Right.
business doing?
Right.
The next thing is, you probably need more money. Like 99.9% of venture-backed startups lose money. Like, at the early stages, they have to, because they're building their market share.
It's growth mode.
So it's like, how much money, if you go out and hire 8 more people, well, you might have a few $1 million in the bank, but what's that going to do to it?
Sure.
If you want to go spend $1 million on social media advertising, which is very common,
Right.
what's that going to do to the amount of, the 20 million in cash you have? You're spending that every month. It's going to take a big piece.
That's
And
right.
I think the other thing is, you need to know when to raise money if
That's
you're
right.
a venture-backed company,
That's
because you might have XYZ going on, and you have all this money you're spending, and you're bringing in money, and you're closing deals, and everything's going great. But if you're off by a few months and you run out of money, like, what are you gonna do? Lay people off? What's gonna happen, which is what I've seen before, is you go begging your investors to give you a loan, and they give it to you every single time. They'll give it to you.
And tell me what that looks like. And let's talk about what that looks like. What does that look like when you go begging for a loan?
Yeah, so basically what happens is they call it a bridge round. Right. So what happens is, you kind of get ahead of yourself, and you expect a big client to come in, and you go out and hire. And again, this is the stressful stuff of business, right?
That's right.
And venture capital investors are very friendly, much more friendly than other type, regular, sharks, so let's say, you think this big client's coming in, you go hire 20 people, you go spend all this money on tech infrastructure and stuff like that. And then it turns out, and you thought you were gonna, this client would, the revenue offset the expenses, and it would help you run for the next, 10 months, and you would start raising 6 months from now. Turns out the client doesn't materialize. You've already expended that. So usually what they'll do is they'll give you, and you thought your valuation was going to go, let's say from, 50 million to 500 million.
Right.
So, and you're going to, have a very maybe sell 10% for 500 million, and you're going to you weren't going to be diluted. Everything was going to be great. It didn't happen.
Right.
So they'll honor the last round. They're not going to make you raise at, a $20 million valuation, because there's stock option plans involved, and everyone would get very upset if their stock went down. Right. So they'll give you let's say a couple $1 million loan, and that's the thing. But the problem, and it's one of the great questions about this is, how do small businesses get money like that if you're not venture backed? And if you don't have a lot of experience, you're probably not going to qualify for a business loan unless
that's a good point. Yep, that's right.
No, not everyone's that fortunate, but again, this is a scalable venture-backed business problem. Not most businesses aren't as risky as these.
Yeah, absolutely. So then that's a great point. So what would you say if I have a business, what are investors looking for? Like, I mean, I know that's a very broad question, but what would you say, like, if you wanted to go into a venture-backed business, what would investors be looking for? I know we talked about a proof of concept or a minimum viable product, and then, hopefully maybe potentially pre-revenue or actually starting to make revenue. But what would you say some investors are looking for in a company?
Yeah, so it depends really. So I think a lot of times the early stage investors have some kind of idea of what your industry. So I think something that's simple to explain would be very helpful. Right. You don't need to be like, well, we're doing this and this and this and this. And it's like, well, I don't really get it. It has to be simple to explain. But really it's that, one, you are an honest person. People want to work for you. So I'm just talking about the actual CEO or founder. Sure. The hardest part about scaling a business is hiring. And if you can't get people to work for you, you have to have some charisma. So it's both charisma for, unless you were just Mark Zuckerberg and the best of all time, it's really you got to you can be so special, or you can be extremely wealthy. You don't necessarily have to be charismatic. But
right.
If let's say you're not extremely wealthy, and you're not the number one person in the world in your industry, which 99.99% of people won't be, you're probably looking for, they're looking at you, right? Because everyone's gonna lie and say, oh, this is gonna be a $1 billion, $10 billion business, right?
Right.
And that's okay. No one really knows, but do you have those things we talked about? Do you have that passion?
Right.
Do you love this business? Are you mission driven? Can you get other employees to also believe you're mission driven? Right. And is it actually that big an idea? Right. And is it something that anyone can do? If what's the do you have some reason why you would make it succeed better than someone else?
Right.
So and it could just be no, you don't, but you're the only person doing that right now. Which could be bad. Right. It could be good because you have a big head start, but it could be bad. And I think this was big with I remember a few years ago the Instagram stories.
Yeah, that's right.
But that was not a thing with I think it was they copied Snapchat on it, and it was one of those things that is just oh, well, it didn't end up hurting Snapchat, but very easy for these companies to just copy things.
Copy and duplicate, right? Which is, that moat piece, right? What's the piece that differentiates you, right? So you're always constantly just trying to make sure that you're getting ahead of your competitor, which is actually kind of the last thing I think we should touch on. So, you kind of gave us some good tips as to what, business owners should be looking at in terms of, hey, if I'm going to get involved, these are some of the things I should do. We talked about some of the things that investors are looking for. So give us a couple of mistakes. I mean, listen, I think you said in the beginning, you've taken 8, 9 companies, was it 10 companies to $1 billion status?
Yeah, 12. Yeah.
12 to $1
Yeah.
billion.
And in full disclosure, these companies would have been $1 billion companies without me. I helped them, but
you were influential. You were
I was
influential in the
like,
plan. Let's just put it what it is. You influenced that part of it. And I think that's amazing. And I think, you should lean into that, Dave, because your finance background helped them to make the right decisions to get through those startups, those raises, to get them to be the unicorns that they were. And people listening to this, hopefully, will reach out to you and maybe look to go through some raises with you. But here's the question. What are a couple mistakes that companies should really, just from your experience? Hey, you've seen guys do it well, and you've seen guys probably tank. So what are some common pitfalls and mistakes that you've seen, maybe from a finance standpoint or just overall, that you're like, man, just from what I've seen, maybe these are a couple of pitfalls you can avoid? Do you have any advice for anybody?
Yeah. So again, it depends on the business, right?
Of course.
Yeah. So if you're a venture-backed business, I would say on the finance side, the biggest common mistake on the finance side is thinking it doesn't matter for too long. It doesn't matter for a short period of time. So you might have, once you raise $500,000, $1 million, it doesn't really matter that much. After that, it does matter, and it's really hard to catch up. So a lot of times I've had to bring on a team of a half dozen people to clean up the books of companies that were going through a monster fundraise and just nothing made sense. And they hadn't charged sales tax ever because they didn't think it was important. They never properly invoiced clients. They never collected money because they had so much money in the bank. They raised so much money. So it's a really common for startups not to collect money that's owed to them, because it's just they don't want to. But if they had actually looked at the finance side and as great as their product is, done that, it would have been a little bit easier. That being said, rarely does the finance side bring down a business startup because they're so well capitalized until the later stages. But it's really annoying when you go through diligence at the later stages and and nothing makes sense and people call you out on it.
Wow.
So I would say kind of know what's important, know what's not, and talk to an expert like me or someone else, or that could basically say, hey, focus on this. You don't need to focus on that. You don't need audit-proof financials when you've raised $10 million. No one cares. They just need to be good. Sometimes a B plus. You know how it works as well as a B plus. You could study for in 3 hours, but to get an A plus, you got to study for 100 hours.
Right.
The B plus is usually good enough if you have limited resources, because you can use those other hours building out sales and producing your product.
So
go ahead.
Go ahead. No, go ahead. You had another mistake?
I was gonna say, for the other side of the business, the pizza places, or my business, the old frozen yogurt shop, just be aware of cash flow, and just watch that cash bank. I would say that's usually, and prepare for taxes, because when you have a small business that's profitable, you got to give a third of it away at the end of the year. Yep. So be prepared for that. And understand, if you can, build a budget so you have an idea of the cyclic, the seasonality of your business. If you're doing all your, so you can ramp up your inventory. Just be aware, because no business goes straight up. There's always ups and downs, both throughout the year and long term. So a lot of businesses that were on fire pre-COVID didn't do so well when everything was closed, and then they panicked, and then it was oh, now we get this government money, now we're good again, and then it just keeps opening and closing. So always have something in the bank and keep a reserve, because stuff always happens that's bad.
Is there a good reserve? Is there a good reserve amount? Before I'll ask you this last question, and then we'll wrap up. But is there a good amount for a cash-based business like that you recommend for a decent reserve, or is there?
Not really. It really is business dependent, right? Sure. You got to know, I would say, couple payrolls, would be good. But what you don't want to do is be oh, I had a good month, and then take all the money out of the business and buy a car or something. Right. When you run a business, you got to be really frugal. And really, it's not your money, even though it kind of is. And just, put it to the side and don't think you're So I remember I heard this once, like, it's never as good as you think, and it's never as bad as you think,
I like that.
with a business.
I like
And it's
that.
like, don't let yourself get too high when things are going great and that good times are gonna last forever. And don't get too low when you have a bad month or something like that.
That's
Easier said than done.
No, but that's really good advice, because a lot of times as owners, we get so myopic and it's like, oh, we're having a bad month and it's just, crazy. So, all right, well, let me ask you this, Dave, if there's others out there listening, and let's say they've got a VC based startup, or they're just maybe going into the tech, world, and they're getting to the place where they need somebody out there to guide them through their seed series or their series A. Is this a good description of how they should probably look at somebody like yourself or reach out? And if that is the case, what would be the ideal business that should tap resources like you, and how would they get a hold of you?
Oh, thanks for asking.
Yeah.
So I would say, you're raising a seed, series A, series B, and you're kind of like, okay, we kind of haven't really paid much attention to the finances yet, and we're not sure what's important. We need to kind of craft our story. We need a budget, we need a model, we need to get through diligence, but we're not even, it could just be you're not aware of the story. It could be that, someone offered you $500 million for your business and you want to sell it. And you just need an expert. So those would be the kind of situations where I'd come in. I'd be a little early for companies that were pre-revenue, unless they had raised, $10, $20 million, something along those lines. Because again, I want to be cognizant that, at the beginning stages, most businesses don't need someone like me. It's a little too much horsepower.
Mm-hmm.
Prove out your product, see what you have, and then let's have a conversation about where you're going. Because when you're too early, anything is possible. It's like an infant, right? Like, they could be anything in the world. Who knows? Right. Once the business is established a little bit, you kind of know where you're going. That's where I would come in.
Can you come in from the rescue side?
Or I don't like it because it's really a lot of work. but I've done it before.
Yeah.
Where companies spend too much money.
Sure.
And we need to cut costs.
Right.
But a lot of times, and that's really, you have to have. It's not like I'm going to be the person making the layoffs, but you would have to, have a team approach. And yes, I've done that also, but it's not as fun.
So maybe fun's not even the right word. So basically, from your skill set, maybe this is a better word. You're the right tool for helping businesses go through, profitable scale, from a startup to a scale up. Maybe that's where your best utilization is. That's where your success lies, is going from startup to scale up and through seed rounds. That's where your best.
Yeah, I would say that's I would say from when you get your seed round to when you sell. Like, I could totally help you with that. There's people that are probably much better at cutting costs and doing all that stuff than me.
It's just
and the best way to reach me is, my website's dashboardfinancial.com. My email is dave@dashboardfinancial.com.
Dave@dashboardfinancial.com. Dashboardfinancial.com. Thanks, Dave. We appreciate you having you today.
Great talking to you, Albert.
Thanks.
Well, bye.